There's a number in your bank account right now. You can see it, you can spend it, you can transfer it to someone else. But here's the thing, that money doesn't actually exist, not in a vault somewhere, not in a pile of cash with your name on it. It's just a number in a database. And the truly strange part, most of it was created the moment someone else went into debt. This isn't a conspiracy theory. It's just how the system works. And once you see it, you can't unsee it. Let me show you. Imagine you're 5 years old and you want to understand where money comes from. Your parents might tell you the government prints it. And that's partially true, but it misses the bigger picture. Because most money, the vast majority of money that exists in the world, was never printed at all. It was created by banks, out of nothing, with a few keystrokes. Here's how. Let's say you walk into a bank and ask for a loan. Maybe you want to buy a house. The bank looks at your income, your credit score, decides you're good for it. They approve you for $300,000. Now, what do you think happens next? You might assume the bank goes into its vault, counts out $300,000 that other people deposited, and lends that money to you. That's what it feels like, right? That's what most people believe. But that's not what happens. The bank doesn't take money from someone else's account. It doesn't shuffle existing money around. Instead, it opens a spreadsheet, types $300,000 into your account, and that's it. The money is created. It didn't exist 10 seconds ago. Now it does. You just created money by going into debt. And this isn't some technical loophole. This is the design. This is how the modern financial system generates most of the money supply. Around 90% of all money in circulation right now was created this exact way. Not by governments, not by central banks, by regular commercial banks making loans. The term for this is credit creation, but honestly, that sounds too boring for what's actually happening. A better phrase might be money out of thin air. Now, you might be thinking, wait, how is that allowed? How can banks just invent money whenever someone signs a loan agreement? Good question. The answer is because we let them. Because the system depends on it. If banks could only lend money that was already deposited, the economy would freeze. There wouldn't be enough money to go around. Growth would stop. So instead, we built a system where money supply expands and contracts based on demand for loans. When people borrow, money gets created. When people pay back loans, money gets destroyed.
It's elastic, it's flexible, and it's completely disconnected from anything physical. There's no gold backing it, no commodity, no vault full of cash, just trust, just agreements, just numbers in a computer. And here's where it gets weird. Because if you pay back that $300,000 loan, that money disappears. It gets deleted, erased from existence. The bank doesn't keep it in a pile somewhere. It's just gone. The only thing the bank keeps is the interest you pay. That's their profit. That's what they actually earn. So the money was created when you borrowed it, and it vanished when you repaid it. The whole time it was temporary, which raises an uncomfortable question. If most money is created through debt, and debt has to be repaid with interest, where does the money to pay the interest come from? The answer is more debt. Someone else has to borrow money into existence to create the cash needed to pay your, and then they need to pay their interest, which requires someone else to borrow, and so on. The system only works if lending stops. The whole thing collapses.
Let's talk about limits for a second. You'd think there would be strict rules preventing banks from creating infinite money. And technically there are. They're called reserve requirements. The idea is simple. If a bank wants to create $1 million in loans, it needs to hold a certain percentage in actual reserves, maybe 10%, maybe 3%. But here's the thing. In 2020, the Federal Reserve in the United States dropped the reserve requirement to 0%, meaning banks can theoretically create as much money as they want as long as someone is willing to borrow it and the bank thinks they'll pay it back. No reserves needed, no limit. Now there are other regulations in place, capital requirements, stress tests, oversight, but the core mechanic remains. Banks create money when they issue loans, and the main constraint is whether people want to borrow. And people always want to borrow. for houses, for cars, for businesses, for education, for everything. So the money supply keeps expanding, not because the government is printing cash, but because the economy runs on an endless cycle of credit creation. Here's what makes this ironic. Everyone worries about government debt, about deficits, about central banks printing money and causing inflation. And sure, those concerns are valid, but they miss the elephant in the room. Because for every dollar the government creates, commercial banks create 9. The money you use every day, the money in your checking account, the money you get paid in, wasn't created by the Treasury Department. It was created by Wells Fargo, J.P. Morgan, Bank of America. It was created when someone, somewhere, signed a loan agreement. And yet, when people talk about who controls the money supply, they point to the Federal Reserve, to central banks, to governments. But the truth is, the majority of money creation happens in private boardrooms, in loan approval meetings, in mortgage applications. The power to create money is outsourced. So what happens when this system breaks? We've seen it before. In 2008, banks created too much money through subprime mortgages. People borrowed money that didn't exist to buy houses they couldn't afford. The loans were repackaged, sold, leveraged, and when the borrowers defaulted, the money vanished. Trillions of dollars evaporated because the debt that created it could no longer be repaid. The economy collapsed, not because of a physical shortage, but because the numbers stopped adding up. And the solution? Government stepped in and created more money. Central banks bought toxic assets, printed currency, lowered interest rates to zero. They flooded the system with liquidity to replace what the banks had destroyed. The irony is perfect. We bailed out the institutions that created the crisis by creating even more money out of nothing. And it worked. Kind of. The economy stabilized, but the fundamental structure didn't change. We didn't rethink the system. We just papered over the cracks and kept going. Because there's no alternative. Not really. The entire global economy is built on this.
Here's the part that should bother you. Most people have no idea this is how money works. They think money is printed by governments and distributed through the economy. They think banks are middlemen, moving money from savers to borrowers. But that's not the reality. Banks aren't intermediaries. They're money creators. And the money they create isn't backed by anything except the belief that the person borrowing it will pay it back. If that belief disappears, the money disappears too, which means the entire system is built on confidence, on trust, on the collective agreement that these numbers mean something. And as long as everyone believes, it works. But belief is fragile. So where does that leave us? You live in a world where 90% of money is created by debt, where banks can generate currency with a keyboard, where the money in your account is just a promise, a ledger entry, a shared hallucination that we all participate in. And it works. It's worked for decades. It's built cities, funded innovation, lifted billions out of poverty. But it's also fragile, unstable, dependent on perpetual growth. Because if people stop borrowing, money stops being created. And if money stops being created, the economy contracts. Debts can't be repaid. Banks fail. The cycle breaks. So the system has to keep expanding forever. Which raises one last question. What happens when it can't?